we have an exciting conversation with Nilesh Shah, Managing Director at Kotak Mahindra AMC. Always a pleasure to speak with you, sir, and great to have you on the show today, especially at a time when viewers, the market, I think anyone who's interested in equities and investments the world over is wondering what is going to happen at this two-day FOMC meet. So let's start with your perspective on whether this is going to be that kind of a moment when you shift to a regime where interest rates start going lower. What does that mean for India?
So one, FOMC moving on interest rate is well discounted by the market. Till 1 week back, it was 25 basis point rate cut. Now it is 50 basis point rate cut. Now Fed will have to do double communication in Ellen Greenspan's style. To equity market, they'll have to convince that we are cutting interest rate because inflation has come down. And to debt market, they'll have to convince that we are cutting interest rate because growth is slowing down and there is a need to boost the economy. If Fed can pass two different messages to markets, then I believe they would have done a great job. From India's point of view, as cost of capital starts coming down in US, and as US dollar starts weakening, there is a reasonably good chance that capital will start flowing out of US into emerging market. A lot of money comes now on passive basis, and India is the highest weightage in MSCI emerging market indices. So the FOMC cutting rates resulting into weakening of dollar, resulting into lower yield expectation, increasing more capital flows to emerging market, Indian market should be beneficial.
Nilesh, well, rate cut, of course, almost a given at this stage. What does this mean for India? There is some talk about the carry trade, now dollar rupee becoming the favored carry trade, on expectation that the RBI may not move too quickly on a rate cut. Do you feel like Indian paper still is attractive and may be a preferred bet as compared to Indian equity at the current juncture?
It all depends upon your time horizon. If you are coming with 3-month view, undoubtedly Indian debt is more attractive than Indian equity. If you are coming with 10-year view, undoubtedly Indian equity is more attractive than Indian debt. I don't think so. Any investor can expect a red carpet entry in market. There will be always opportunity once in a while, like COVID-20 lows. But other than that, you'll have to enter the market. And it all depends upon your time horizon. Your time in the market will make money for you, not timing the market.
Nilesh, I want to get into a little more multi-asset talk before we spend some time discussing only equities with you. Gold has been the real star when you talk about assets across the board, be it equity, debt, commodities as whole as well. Do you think it could give over 20% returns in 2025? So even at current levels, gold is a good asset allocation bet?
So if we look at gold's return since March 20, that's driven by central bank buying. And central banks are now becoming like Indian housewife, regularly buying gold and not at all selling. It is their buying which has pulled gold prices higher. The second thing which we have seen in history, whenever US interest rate comes down, gold prices move into next orbit. Now, central bank buying is likely to continue as people diversify away from securities, especially of Western bloc. And also US interest rates are expected to come down. This should support gold prices. Some of these factors are already reflected at current $2,600 gold prices. But overall, the bull run in gold prices should continue. Now, will it go up 5%, 10%, 20%? We are not the best person to opine on the same.
Okay. Nilesh bhai, good morning. Neeraj here. Just trying to gauge what's your sense of whether the template that unfolds could be similar to 2000 or 2008, wherein there was a correction maybe because of a Fed rate cut or a recession or a combination of both, or could it be closer to 2019, wherein the markets didn't have too much of a reaction, and albeit the valuations were a lot more better there than what they are right now?
So Neeraj bhai, is Fed going to say that economy is hard landing and hence I need to cut rates ahead of November election? I doubt if they have so much of political independence. So at least from here till November, I don't foresee Fed saying that we need to cut rates because of high deficit, because of slowing economy. They are more likely to say that inflation is now well under control and we want to be taking preventive action and so on and so forth. Thereafter, let's see how the number comes and what Fed communicates. From our market point of view, we have both kinds of market. There are stocks, especially in large cap, larger mid cap, where business fundamentals are good. Valuations are fairly valued or little bit above fair valued historical averages. And then there are stocks where experience has become liability. Those stocks are running because of concentrated holding, low floating stock, fancy, whatever you call it. In those kind of stocks, whenever supply emerges, there will be correction. If supply emerges tomorrow, there will be correction tomorrow. If supply emerges 5 years down the line, there will be correction maybe 5 years down the line. So we will see stock specific movement. I think, Neeraj bhai, this is the time where you slowly calibrately switch from momentum to quality. And the definition of momentum and quality, each one has to make for themselves. You have to move from low floating stock concentrated holdings to high floating stock and market discovered prices. And you have to move from expensive valuation to reasonable valuation.
Fair point. Okay. The other small follow-up is the quantum of cash that domestic mutual funds are sitting on, plus the SIP money that continues every month. Could corrections this time around, if indeed the same template were to play out, be different and shallower than what's happened in the past? Because that's the most often used tape these days, that look at what's happened in the last 4 years, and therefore corrections, if any, will be shallow. Do you subscribe or do you espouse the same theory, Nilesh bhai?
So let me turn the question in a lighter way. Neeraj bhai, I'm sure you would have seen a Lagan movie where local team defeated English team. We are seeing Lagan playing out in our market every day. First, we saw one day international during COVID time where April, May, June, July, August 20, foreigners came and dumped about 70, 80,000 crore. They just wanted to exit, so there was no price limit. And retail investor kept on supporting mutual fund via SIP. And we kept on buying. And finally, foreigners conceded defeat. Then they realized that one day international is not where we can win. So they came to play test match. Between October 21 to June 22, they sold about 250,000 crore worth of equity. Again, retail investor kept on supporting us. Don't worry, we are sending our SIP money. Just keep on investing in India growth story. Eventually, foreigners tired out and then they withdrew from test match. Then they realized that we can't win against retail investors and mutual funds in one day or in test match. So let's come and play T20. So on the election result day, they came to play T20 and one single day they sold more than 20,000 crore. Now this time retail investors said, mutual funds, you move out, we'll give you some money, you can do what you want, but let us play directly. They pumped more than 20,000 crore in a single day to take out all the foreigners selling. Now with this kind of domestic participation, you can very well guess what kind of corrections will come and how swift it will be. The point is, in this market, we do expect limited downside for quality stocks, for high floating stock counters, and for reasonably valued stocks. The wall of money cannot stop overvaluation to get corrected. We have seen that in 90s, we have seen that in 2000s, we have seen that in 2008. Money alone cannot support stock prices for long. At the end of the day, stocks are slave of earning power. So my feeling is that the correction for the broader market will be limited, will be shallow, but there are stocks where corrections will be painful, as in when supply emerges.
You know, just wondering, Nilesh, you talked about valuations a couple of times and mentioned how we have to look at stocks which have not hit their peak valuations. I'm wondering, for you, has your definition of what is overvalued changed in a market that has ignored valuations for some time now? Are you re-looking at the way you see valuations?
So Tamanna, at 50 plus year of age, I am not going to change myself. As I mentioned earlier, this is the market where experiences become liability. But I'll rather retire than change what I think is unfair. We have seen cycles. In the 91 cycle, I ended up losing all the money because I had no experience. In 2000, we could separate us out. In 2008, we could separate us out. So we know there will be periods where exuberance, irrationality can result into momentum stock outperforming you. It's far better to underperform in those markets and tell your investors, tell your distributors that this is our philosophy, this is what we are doing. And I'm not generating performance by chasing momentum. Now,
That right now? Are you seeing that right now, exuberance and irrationality?
undoubtedly, in some parts of the market, there is irrationality. Low floating stock is resulting into valuation of banks trading at FMCG company, capital goods trading at crazy valuations, real estate and construction companies also showing that kind of sign. So there are pockets, especially in micro caps, mini caps, small caps, and some of these sectors where markets are discounting too much optimism. Maybe one or two out of that will be able to deliver, but not all. And then there are pockets in IT, in FMCG, in pharma, in chemical, in banking, where valuations are reasonable. They may not start outperforming market from tomorrow onwards or today onwards, but over a period of time, stocks are slaves of earning power.
Nilesh, are you bullish on the entire BFSI space, or are you selective in this segment? Banking sector, of course, continues to see challenges on account of deposit mobilization, but if we do get a rate cut, that could be positive. The NBFC sector, capital market related segment also looks pretty good. Of course, valuations have soared recently. How would you play this whole pack?
So within banking today, we have to wait and watch how liquidity coverage ratio guideline comes. Those guidelines could have potential adverse impact on the NIM of the bank. The second thing will be obviously deposit and credit growth. Today they are in low double digit. Can it move to slightly higher level? And third thing is valuation. Undoubtedly, valuations are now trading below historical averages. So we are overall bullish on banking system on a selective bottom-up basis, but we'll wait for liquidity coverage guidelines impact to come through and then start accumulating furthermore.
Also, I want to talk to you about a product in some sense, right? So from more of an investment angle, we saw a beautiful rally over the last 1 year on some of these PSU stocks and hence on PSU mutual funds. Investors who invested in these funds have made phenomenal or created phenomenal wealth. But as we stand at a juncture where the PSU house is split between some that have ran up significantly, like those defense and railway counters, to some like energy stocks that still show value, what would be the advice to investors who hold these PSU mutual funds? Right time to exit, right time to invest, or just do nothing?
So my recommendation will be, if you are in passive funds, then look at the composition. If the composition is tilted towards low floating stock counters, highly overvalued, then it is time to book profit. Don't do it today itself. Do it in a calibrated manner, because unless until supply emerges, these counters are not going to fall. Emergence of supply, increase in floating stock is absolutely important for these stocks to come back to their fair value. On the other hand, if you are in those PSUs where valuations are still reasonable, there is reasonable floating stock to determine that price, then you could stay invested. If you are in active PSU, then let the fund managers take a call as to when they are going to make a switch, as to how they are going to position portfolio in terms of market expectations. So active PSU funds continue, passive PSU fund, look at the portfolio and make a calibrated switch.
Um, I'm wondering, how are you feeling about the primary market right now? The primary market, I think, is the most action that we're seeing, and there's been a blockbuster listing yesterday. Bajaj Housing Finance is the talk of the town. Let's start with your views, Mr. Shah, first on Bajaj Housing Finance, and then all the buzz that you're seeing in the primary market.
So we can't give stock-specific comment, but in the primary market, undoubtedly supply is coming, and a lot of those supply is getting absorbed at by the retail and institutional investors. There was a time when once for selling an issue, you had to travel to Singapore, Hong Kong, London, New York. Today, you can sell that issue in Bandra Kurla complex or Lower Parel at best. So there is an emergence of domestic retail and institutional investors which can carry out the IPO. This primary market supply is increasing undoubtedly as valuations have become attractive. And going forward, I think at this valuations, one will have to be careful while investing in primary market IPOs. Many of these primary market companies are getting listed at a substantial premium to existing listed players. Over a period of time, that will get corrected. So be careful as to what you are investing into. Don't apply based on gray market premium. That's not reliable. And do keep in mind valuations, because it's not that every primary issue is going to get listed at premium to their issue price. Price is what you pay and value is what you get. And one final thing which I look forward to primary market, by and large, top of the market is made by a large issue, which is very, very expensive. We saw that in 2008. We saw that in 2017-18. So I'll be looking forward to primary market, hopefully, where history repeats itself. And there will be one large issue which will be very, very expensive. And that hopefully will make the top of the market.
Okay. Nilesh bhai, one final question from my end. The other common tape is that large caps, because of the valuations, are best placed right now or better placed right now, and mid caps, small caps are not. But a lot of emerging themes are not necessarily large cap themes. They are not present in the top 100. So would it be wrong to shun the broader end of the spectrum, or do you reckon that if there is a mid cap, small cap correction, then even the good stories will fall, take a very sharp hit?
So Neeraj bhai, there's no general statement that large caps are cheap and small and mid caps are expensive. At the end of the day, it is all bottom-up story. If large caps are not growing, then even this valuation may not sustain. And if small and mid caps are growing at a faster pace, undoubtedly this valuations can sustain. So it is more of a bottom-up stock picking. Try to factor in what market is pricing in at current valuation. If it's pricing in 100 P, that means we are discounting 2,124. Now, will the company be able to grow so fast that maybe we are just discounting 2,034 and not 2,124? That's the call. Any company which is going to deliver below what is expected by the market is unlikely to deliver return. So between large, mid, and small, try to go for companies which have leadership in their industry, which is able to withstand technological disruption which is coming, and where the business fundamentals and financial valuations are reasonable. Today, we are seeing many companies' prices have run up simply because there is limited floating stock. There are companies where prices have run up simply because people are pricing in unrealistic expectation, in our opinion. So try to figure out what market is pricing and then build your portfolio around it.
Thank you, Nilesh. Thank you. It's always so good to have you in the studios, and of course, even more important when most people believe that we are in a secular bull run, and valuations, of course, though, continue to remain a concern.